what's a melt up? Tell us what the heck a melt up is and what does that mean for real estate and other assets?
We need to really be aware of this possibility because you've been seeing it in the stock market throughout most of this year. A melt up is when an asset class defies the logic of the economy or that asset class. So a melt up until recently in the stock market was the stock market was still just going up, even though the economy was clearly trending down. The real estate market in some places going up, even though clearly the market's trending down. And I want to create this visual. The Federal Reserve, in order to stop inflation, the pot was boiling and they came over and they stuck a lid on it. But the water's still in the pot and the water is still boiling. So the lid's kind of, rattling around the top. Ting, 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 ting. You all know what I'm talking about. Because I think we need to be really aware that we just put a lid on a boiling pot. And I've got some numbers to prove this. From 2008 to 2014, the Federal Reserve expanded their balance sheet through money printing, through quantitative easing, by $3.5 trillion in the last recession. About $800 million was for TARP, the Toxic Asset Relief Program. And that's where they went and purchased the bad debt from the banks in order to bail out the banks. The rest was them buying bonds and then stimulus through infrastructure. But it was still $3.5 trillion. That caused a 10-year bull run, one of the biggest bull runs ever. And the only people who lost money was Zillow flipping homes at $1.4 billion. Okay, everyone else made a shit ton of money, and asset values shot through the roof. And then the Fed goes, oh my goodness, COVID, this is really bad, really bad. We got to turn on the money printers. They got to go and just crank away. So let's talk about what they did in COVID. So in 2020, they put out $5.2 trillion for COVID relief, which increased our money supply by 27%. On top of $4.5 trillion for quantitative easing, aka purchasing of treasuries. Another $2 trillion in planned infrastructure spending. So they have $13 trillion in new money, which is a 35% increase. This blows my mind. In money circulation, which is 60% of our GDP. This was more than the money printers. This was like an aircraft carrier of money printers just blowing it all over the ocean. But let's go back. If 3.5 trillion caused a 10-year bull run and we just printed 13 and the Fed said, just kidding, we're going to put a lid on it. But that pot's still boiling. It's just rattling around. They're going to have to pull the lid off eventually. So right now, what it is there is something that's called real interest rates. And real interest rates is what defines whether monetary policy is restrictive or not restrictive, which helps the economy to grow fast in a non-restrictive, aka high liquidity environment where money is cheap, free, and easy, or it's restrictive when money is not cheap, free, and easy, and money costs a lot. So we are currently in a restrictive. Real interest rates is what happens when you adjust for inflation. So the Fed funds rate is right now is 5.5%, and the Fed's favorite metric, PCE, is 3.4%. That's how they measure inflation. It's not just CPI. So this is approximate math. We're doing ghetto Arlington math here. That's where I grew up. I love Arlington, but this is just simplifying the math. So you take the 5.3%, you minus the 3.4% for a real rate of 2.1%. That's what causes the economy to contract. This is what causes the money supply to slow down, the liquidity to go out. So when the Fed says, I'm going to stay higher for longer, this is what they mean. They mean they will stay restrictive. But sooner or later, they've got to pull the top off the pot. And the water is still in there boiling. So asset values are going to melt up and naturally lift. So what does this mean for people? Go buy assets, stocks, bonds, real estate, guns, gold, things to make booze. Okay, the last part's a little bit of prepper stuff, but you get the idea.
Bitcoin.
You're probably going to see a bull run that then lifts it after we go through this fake recession that is forced by the restrictive monetary policy. And when they say higher for longer, they don't have to maintain the Fed funds rate at 5.5. Because if inflation comes down to just 3, they could lower it by almost a 0.5 percentage point, which makes everything cheaper, but they're still restrictive. So higher for longer doesn't mean the Fed has to stay at 5.5, which will then cause real estate, the 30-year debt, to be cheaper too, which causes corporate debt to be cheaper, which causes HELOCs to be cheaper, business lines of credit. Do expect higher for longer, but don't expect it to be this high the whole time. This is why I keep saying we believe it'll start to float down towards the latter part of 2024. And then be prepared for this idea of a melt up in assets, of assets just naturally lifting because of that 13 trillion that was printed. You actually sent me down this rabbit hole. That's the funny thing.
How so?
Well, because of the original Zillow article that we started talking about, my brain was like, what other data are we not paying attention to? So I start going through this, and the Zillow article led me to, the K-shaped recovery, which led to the people with assets rise. Well, what else is affecting asset values right now? Real interest rates. Well, what's going to happen with real interest rates? Real interest rates are going to stay higher for a little bit longer. But wait a second, we still printed 13 trillion. If we printed 13 trillion, asset values have to rise. It means prices are never going down again also, and things are going to be more expensive in our future.
That was like a crash course, quick version of Economics 101. It was very detailed.
Smash the like button, hit subscribe. Thank you for watching. If you enjoyed this video, watch this one too.